Hello everyone, hello Finimizers. Welcome to another Finimize Live event. My name is Stefan. I'm an expert portfolio manager and an analyst here at Finimize, and I'm pleased to be hosting today's event on a beginner's playbook for investing this year with our partner CFA Institute. Let me just wait maybe a second. I can see the number of participants rising. That's a great thing. So yeah, I'll just let maybe a few seconds for everyone to be live. Actually, I can start with some housekeeping rules to run through. Maybe you can, introduce yourself in the chat, tell us where you're tuning in from, and remember to switch to all attendees so everyone can see your messages. This is going to be a 15-minute discussion followed by a 15-minute audience Q&A. So please use the Q&A box to ask a question. And if you see a question you like, you can upvote it so it moves to the top, and that way we can get through the most upvoted questions first. Okay, great. Let's kick this off. So our event partner for today is CFA Institute, the global association of investment professionals that sets the standard for professional excellence and credentials. In other words, the global gang of investment pros. That's how I would describe them. They're all about setting the bar high for what it means to be top-notch in the finance world, big on ethics and even bigger on smarts. They're here to make sure investing is done right, keeping markets sharp and economies buzzing. With a squad of over 119,000 CFA charter holders across 160 markets, it's fair to say they're pretty much everywhere. And I have to admit here, I am part of that gang. Now, today, we're rolling the red carpet for Andres Vinelli, the financial wizard and chief economist at CFA Institute. Andres is not just crunching numbers, he's leading the charge in research and advocacy to give us the lowdown on financial markets. He's a Harvard PhD holder who moonlights as a professor at Georgetown. And if that's not enough, Andres has also been the economic brains behind some major players like the US Public Company Accounting Oversight Board and the Financial Industry Regulatory Authority. Plus, he's done his time as VP for Economic Policy at the Center for American Progress. Yeah, I think it's fair to say we're in for a treat. Talk about a financial guru. Andres, great to have you here. How are you doing today?
Stefan, thank you so much. It's great to be here virtually sharing this conversation. I'm today in Florida, in the US, but I see that we have folks from all over the world, lots of people from India. Good evening, appreciate taking the time at midnight.
Awesome, Andres. So let's dive in. So look, everyone was expecting a recession last year and pretty much also this year, I think, yet the economy remained pretty solid. So, can you explain very simply what's going on in the economy right now?
Absolutely. We have seen quite a bit of inflation after the COVID crisis. And what got people worried about last year was that the central banks had to increase pretty dramatically interest rates. And that is a classic recipe for fighting inflation. It's working. But people were fretting about the possible side effect, the unintended consequence, which is cooling economic growth to an extent that we call a recession. For instance, in the UK, it went practically the interest rate from 0 to 5%. That usually spells recession. But the good thing is that as many central banks were all fighting interest rates, things got easier, and we got a lot of the good side of the medicine without a lot of the bad effects. What's happening in the background is that the supply chains are mending, which was a big problem for inflation. Things are basically getting into the right place, and that made things better. So the UK avoided a recession this year, and the world is back on track with a decent amount of growth. So a close call, but it worked.
Thanks a lot, Andres. So how should beginner investors approach 2024?
Well, there's always risk and opportunities out there, and they're, of course, hard to predict. What I would say is the social media feed and the newspaper are not particularly useful. We have, in fact, a new report on financial influencers that we are circulating a link to all you folks. It's those are good to get information. What I would say is that there's a lot going on. The risks are things like war, but the opportunities also are there to enhance productivity. AI, artificial intelligence, of course, comes to mind. UK macro expected to be comparable to last year with some better wages. But for investment purposes, what I would say is disregard macro considerations and center on timeless advice. Settle on a savings and investment plan for the long run that works for you and execute with discipline. This is what I like to think about, Stefan, is that it's like owning and running a farm. It's for the long run. It's for the long run. The biggest decision that you have to make is what you're producing. Is it agriculture? Is it livestock? Is it forestry? Or is it a combination? What I say is go for a combination, right? The most important decision that you might have to make in running this investment farm is which is going to be your biggest crop, okay? And then you need to diversify on that. What I would say is do what's right for you in terms of having your biggest crops. For most younger investors, this means stocks. Stocks should be sort of the biggest economic activity you have in your farm, but other ones help diversify your risks. Now, what I would say about the plan and stick it to the plan is come up with a plan. You can tweak it over time, but stay the course. As they say today, diamond hands, but not about a stock, not about a single stock, but about your plan. Diamond hands about having the plan, whatever it is that works for you, Stefan.
So, to make it a bit more practical, so what sort of asset classes should they be, thinking about when it comes to long-term investing?
Absolutely. Think about stocks, perhaps the main for most people. Think about bonds and cash products. In investment, we talk about cash, but it's things that are like checking accounts and stuff like that. Think bank accounts. So bonds, some of those cash instruments, real estate, and also there's some alternative. Of course, these days, crypto assets are a big alternative, but it's not only that. You can go into commodities, other alternative investments, but they should be all like side dishes to the main dish, which should be stocks. On the long run, stocks tend to do very well. Of course, the key is that you have to keep the long run. But those are the main components. And then ideally what you want to do is have diversity, not only across these big things, these big asset classes like stocks, but also within the stocks. You should have 1 or 2 stocks, but probably stocks that have diversity to them.
Okay, that's awesome. Maybe you can also just remind our listeners, what are bonds? Just maybe explain it very briefly, why they could be, as you say, the main course should be stocks, but why would potentially bonds be useful as a side dish? And also what exactly you mean by diversifying within stocks, and maybe give a few examples of sectors or stocks that could work well as diversifiers.
Absolutely. Let's start with stocks, and then we'll go into bonds if that works for folks. So within stocks, we're not talking about just, hey, I like this particular stock, I would like Microsoft, or I would like this or the other. What we are talking about is, well, when you own stocks, you own a little chunk of a company. So you are a owner of a little tiny bit of some company out there. But you can usually buy stocks from your own country where you reside and overseas. So there you have already a source of diversification, which is, people call it the only free lunch in this investment business. Let me give you a concrete example. If you invested last year in UK stocks, you bought something, wide variety of UK stocks, probably you ended the year more or less flat. You got more or less the same as you put. Now, if had you put that into, say, the U.S. market, well, you would have 20% more because it went to lose over 20%. What that means is not necessarily that you have to favor the U.S. over the U.K. What it means is nobody knows what's going to happen. So you're better off having diversity, in this case, geographic diversity. And I mentioned this because there's a human tendency we all have, there's studies on this, to overweight, to put a lot of stock into your own market, the stuff that you know. And it makes sense in many ways. But if you get exposure to different types of countries, you can ride different waves. For instance, in the US, what drove that 20%? Mostly the surge in AI, artificial intelligence, and all the excitement we all have about IT and technology and all of that. Well, many of us didn't know that that's exactly what's going to happen. So you have to diversify like that. Of course, you need a little bit of everything in order to be very diversified. And that means companies that produce stuff and companies that produce services. And all that. Now, you asked very, what does it mean to own bonds? Those are a little bit more mysterious, perhaps, but they don't have to. Basically, it's a loan. It's like you're doing, you are giving money to a company for a loan. So if the company or a government issues a bond, a 10-year bond, you might buy that bond. And basically, at the end of those 10 years, that you will recoup your investment money, plus they give you a little bit of interest rate every year. Now, that adds diversity in your portfolio. It adds safety, especially if there's no default at the end of the 10 years. So usually government bonds tend not to default when you're putting into a bond of a Coca-Cola or a bank or Microsoft or that. Things could happen, but they tend to be more stable as investments. So they serve a little bit as a stabilizer in your portfolio. The same goes to cash.
Thank you very much, Andres. Now, before we move on to the Q&A, I just want to make the most of having you here. And, you've got an impressive CV and experience. So what are, your top 3 tips? And let's try to make them as practical as possible for investors beginning today.
Absolutely. I would say know your threats, your enemies in this farm, right? Just like farms have a danger of fire, or drought, or pests, you need to know what your enemies are in the world of investing. And I would call it 3 enemies: fear, greed, and cost. Fear, greed, and cost. Fear and greed is, well, we open the newspaper, open TikTok, see what's going on, and we have a hunch. We have a new idea, and we act upon it. That is usually talked about as greed, or fear. If you're saying, well, I'm going to sell everything and put everything to cash under the mattress, figuratively speaking. So those 2 enemies, fear and greed, make you overtrade, which is not good for your financial health. I know several people who, after the market went down, basically moved all their retirement accounts to things that are very safe, and they missed the upside that came afterwards. So fear and greed, the good news is that they're all within your control. You can try and control it, and there are ways to do it. Diversify, of course, into ETF and broad-based index funds. Those are very good. And the final one is cost. Of course, when you trade more, you get more cost. But think about things that are a little bit less evident than the commissions in trade. But also, if you trade a lot, you tend to pay more taxes. Those are part of some of the things that drag down a little bit the returns. And also, it takes a lot of time to be trading and there's a value to everyone's time. So keep it simple. Keep it simple and know your enemies, Stefan.
Amazing, fantastic tips. Thanks a lot, Andres. So now let's move on to the Q&A. So everyone, please feel free to share your questions in the Q&A box and make sure to upvote the questions you want to see answered first. So actually, talking about greed, the first question is, are we facing a new form of a dot-com bubble with the AI nowadays, or do you think that we are heading to a new paradigm shift?
My view is that AI is truly changing the paradigm in the world. We'll talk in a second on financial markets. I think that this is comparable to the printing press, the invention of the printing press, more than the invention of the internet, in that it will change the way we live in ways that we cannot fully comprehend right now. But what I suspect is huge deal. I don't know about valuations, right? You see some companies like Nvidia doing very, extremely well, and it comes to mind a little bit what happened in the late 90s for those that love history, where when the internet became a big thing, everyone knew that that it was part of the future. What history tends to show with innovations like this is that at the end of the day, the society benefits, and these things tend to be a big deal, and basically the economy grows. I think that AI will drive a lot of productivity. We'll be able to produce a lot more with less. But history shows that it's very difficult to pick which are the companies that actually will receive the long-term gains from this. Usually they're socialized, so it's very difficult to know exactly which sector. What I think is that AI will have immense benefits for productivity, and productivity is one of the key ingredients of economic growth. So growth will be going higher. This is good news for young investors that will be able to ride this wave. On the other hand, yes, there will be some crazy valuations on the way there.
Thanks, Andres. What is happening right now is portrayed as a soft landing. We may or may not be a full-blown recession. What sectors do you foresee will comparatively insulate us from a recessionary fallout, and what sectors you see are vulnerable to recession?
That's a great question. I think that the outlook today is that we're not going to see recession in most places in the world. We are getting the Goldilocks economy in some ways. This soft landing that we're talking about, it seems to be happening. It wasn't clear a year ago, but it looks like.
Sorry to cut you here, Andres, but maybe you can just quickly explain what soft landing means.
Yeah, of course. The idea is it's like when you have fever, right? When you have fever, you have to take an aspirin or something like that to cool it down. The problem is that usually when you take too much aspirin, in this case, when interest rates go up a lot, usually you cool economic activity too much and you get a recession. Okay, what happened here is that we administered very strong medicine, from 0 to 5% is the U.S., and you can see across many markets, and we got the lack of fever. Inflation is not yet fully down, but it's on the right path, but we didn't get that uncomfortable recession there. The economists call that soft landing. It's a good thing, and it looks like we're landing there. Of course, recessions will happen. The only question of recession is when, not if, right? But it looks like the stars are aligned, and I think that we are in for good prospects for the economy. Usually, what you want to buy, to answer that specific question, if you're worried about recession, you want to buy what folks in the market call consumer staples. Think about the stuff that you buy on a good day or a bad day. You know, bread, breakfast cereal, um, things that that basically are non-discretionary. Those are the things that traditionally have held isolated, and also the bonds that we were talking about, Stefan, and the cash. Those are good cushions. This is a good time for people who hold cash because the banks are starting to pay higher interest rates, so it's an attractive option if you're worried about recession.
What about healthcare stocks? Because you also, unfortunately, have to keep purchasing, healthcare things in a recession.
Yeah, no, people need treatments all over the place, and the other thing about healthcare. So it's a great idea. Healthcare, of course, is all about a lot about innovation, and there's some interesting innovations happening. There's been a little bit of over the decades, a little bit of slowdown in innovation, and now it seems to be ramping up. I think that AI application into health, the health sector will have incredible benefits for society, for patients, and also it will aid in the discovery of new drugs. And of course, now we have a European company capitalizing on new drugs to fight diabetes and issues of obesity and all that. So there's promise in the sector.
Awesome. Getting lots and lots of interesting questions. Hopefully we'll get enough time to go through them. Next one is, how do you recommend setting goals with your investing? Is there a framework a beginner should follow? Great question.
Yeah. What a rule of thumb that I like, and of course it depends on your personal circumstances, right? And happy to talk about that. But a framework that is very simple that I like a lot is think about the number 110. 110. And then think about your age. So say you are 30 years old. Think about 110 minus your age, minus 30, it leads to 80. This rule of thumb says, well, then you should consider having around 80% of your long-term investments in stocks. Okay, and of course that means that as one ages, it goes down smoothly, but it's not a big movement, right? So that's a good way to start. So I think about that as a starting place, and of course you can modify. If you absolutely hate breath, go a lower stocks. But think about buckets, right? Once you have that big bucket, then think about a bucket for bonds, a bucket for cash, and there's always you should always have some money in each of the buckets at the very least. In that way, you are diversified and you keep it simple. In terms of what to put into the buckets, Stefan, I like broad-based mutual funds. Index funds are very good. Exchange-traded funds are excellent way to get exposure to many stocks. Because when you're beginning, you don't want to go with a hunch or just one recommendation. You want to basically hedge your bets and go as broad as possible. The good thing is that today we have widely available vehicles like that, and they are very convenient price. So you can get to this golden diversification situation without spending really too much money. So start early, go with that, and refine your plan.
So I think you've sort of answered the next question, which is it better to invest in individual stocks or broader indices? But maybe I might add for those that want to actually do both, for those interested in still looking at individual companies, how can they sort of do both in a way?
One way to think about it, it's a core and satellite perspective. As a core, you can have, for instance, a fund that has many sectors exposure, and then think about individual stocks as the side dish that goes with that, where you can have some fun, enjoy the learning. And when you invest in individual stocks, one thing that I have learned over the years is that you learn a lot just by following a stock. So you don't have to put a lot of money. You put, a small percentage in stock. And you will learn a lot just by seeing how it goes, reading the news, comparing with other companies. That's an excellent way. I would say that the one way that you become an expert on this, other than having proper education in this area, is by having stake on the race. You need to have a horse on the race, as they say. If you have a little money, it doesn't have to be a lot. You will care a lot, trust me on this, and you will learn a lot. And when you don't do that, the incentives are just not there to keep on learning. But investing can be a lot of fun. That's a good way, a prudent way of doing it. Be diversified, and then you can perhaps a sector. You work in the health sector, and you have some knowledge about what's going to happen in the future, because the stock market is not really about what's happening now, but what's going to happen in the future. So you can put to good use some of your ideas, but make sure that while you do that, you're still diversified, not only in this case, healthcare, but the whole economy, and ideally around the world.
I absolutely love that core satellite approach. I think that's a very, very great way of organizing your portfolio. So now, are you for or against investing in crypto?
Well, I like to understand what I invest on. That's my posture. And some crypto products I think are suitable because I understand them. Other ones I truly don't understand. And of course there's also fraud and scams going on there, right? So for the things that I do understand, it's fine. It's hard. We just came up a few months ago with a guide for valuation of this type of assets. I would counsel people to check it out. But what I would say, after developing this guide on how to value these things, is that it's very complex, and the dust hasn't settled on how you value these things. So what I would say is you can do it, but as part of the satellite, because it might be that that's a big deal, but we don't know exactly which of these tools will be available. So if you can find a way to be diversified, it can be very interesting, but I would say let's not make that the main dish of your meal, if you may.
No crypto for your main dish. I think a lot of our users will be disappointed with that.
Of course, yeah, no, and I know people feel very strongly about this. And as a matter of fact, we did a survey, Stefan, last year on Gen Z investors around the world. And for many, many people, crypto was their first investment. But you know what? That generation is very savvy. Don't believe what people criticize, right? It's very savvy. They're checking across multiple information sources. And of course, I mean, crypto or stock can be the gateway drug to this game that is a very fulfilling game, which is long-term investing. But regardless of how you got here, you have tools to diversify on that, and crypto is one of them.
And that's why I love so much this core satellite approach. You still have this core portfolio, which is diversified long-term. You don't have to look at it too much. It's got hundreds and hundreds of years of historical data to back it up. And then you can play around with some more speculative investments or higher risk investments with those satellites. So I honestly, I love that core satellite approach. Maybe a last question in 1 minute. Good luck, Andres. Do you have a view in terms of emerging markets movement this year? Is it likely to continue to underperform, so timing-wise, or is it a good time to invest? EM, what's your view?
EM, I'll be careful with EM. I think that it deserves a place. I don't think it's going to be, a full-on rally. Interest rates. Emerging markets are very sensitive to interest rates. Interest rates are a little volatile. The direction is good. You can be there. I think it's going to be plenty of opportunities now that the world is more multi-polar. Places like India, fantastic prospects on the long run.
Maybe another satellite right there.
Absolutely.
Andres, I'm afraid that's all the time we have today, but thank you so much for all the knowledge you've shared today, all the good tips. Hopefully, this has been very informative to everyone. Thank you so much for joining. Actually, just before you leave today, if you can just fill out the short survey that should pop up on your screen. And you just take, if you can take 1 minute or even a few seconds to just let us know your feedback and what topics you're interested in learning more about. Thanks again. Thank you so much, Andres. Thank you, everyone, for joining today, and see you at the next Finimize event. Have a great evening or day or where else you are.
Or midnight in India. Thank you so much, everybody.
Exactly. Thank you. Bye.